The next thing that we have to calculate on our profit and loss statement is interest income. Now, as per given on the schedules, on the assumptions, the interest rate on bank deposits is 3%. As a general practice, we will be applying the 3% on the opening balance of cash and cash equivalents available. Now, the thing is, we don't know our cash and cash equivalents at the beginning of the year as yet. And we will only know that once we have prepared our cash flow statement. Only from there we will be able to find what is the cash balance available on which we can calculate the interest. But the problem is, cash flow statement can only be prepared once we have profit and loss statement and the balance sheet ready for us. Now this is the problem, and for this we will not be able to calculate the interest income for now. Rather, we will skip that, and once we have done everything else, we will come back here at the last and calculate the interest income. Now this is a very good point to explain you the beauty of financial modeling. The things are interdependent. The cash at the beginning is dependent on all of these values from the last year, and then the interest income will be dependent on the cash at the beginning. And once we have calculated the interest and once we add that to our profit and loss statement, this will update my profit, which will go back and update my profit before tax value, which will then update my cash flow statement. But since we are doing this in Microsoft Excel will be automatically able to handle that. We don't have to worry about updating everything, but we just need to make sure that we are linking our formulas properly, so that when anything here changes, rest of the model is automatically updated. So long story short, we are not able to calculate interest income now. We will come back and do it once we have done our cash flow statement.